Right, so Case made it pretty clear and introduced myself. So I'm the president of the Association of Credit Management in Switzerland. There, what we do is we as credit managers coming from the big industry help credit managers working in smaller industries, small and medium-sized companies, and bring them up to speed to that knowledge what we have all gathered together in our big corporations before, right? So, and that was also a main driver why fintech is on our radar screen, and how we can use the new financial technologies to provide them to small and medium-sized companies to gain access to that knowledge to a decent price, and make it available for them to work with that on their own, and also having, like, the platform is finally the association to come back to us, ask us, also receiving the generally accepted credit management principles that are published there, which are the foundation of the book that Case has just mentioned, which is Code of Best Practice. The book itself contains credit scoring models, among other things like reporting tools and all that stuff that is in there, and procedures, standard procedures and all that stuff. But the credit scoring models were the starting point then to developing financial technology solutions on top of that. But before I go into that one, this will be my very last slide to come back to that topic again. I will go a little bit about what we see in Switzerland, right? You know, Switzerland is extremely small, a small country, but having like a lot of big companies, corporation, having their headquarters there, right? And so we have a very broad and international mindset there. And I want to just share a little bit what we see. It is a collection of slides that that I present to you for you to gain an understanding where we are today, especially after 2020 being affected or disrupted by the COVID-19 virus, which had an effect to our economies, right? And of course, from the Credit Management Association, it is important to us to see what's going on. For instance, this is one indicator that we have to look into our bankruptcy levels, right? So where is it? Where are we today, right? So you can see on that graph that we have the information from 2019, then 2020, and now this is until May 2021. And we want to understand what's going on. What I see here, we saw in March an increase in the bankruptcies, but it is much less than we expected that will happen, right? That is still being not on tremendous levels. It's moving and navigating at the same levels roughly than we got used to that, mainly caused by the situation that that the government has injected liquidity here, right? And that helps companies to survive. But we know already from different data sources that the revenue in the industries went dramatically down, especially industries like in the service providing industries that are affected big time, right? And we are watching that here. So still not a big effect, but we expect some more to come. And what we do within the association is to prepare people for that, to see what customers or suppliers might be at potential risk. We did a market study by the end of 2019, beginning of 2020, and we were analyzing the data that came back to our members over here. And one of the questions that we asked them was, who in your company makes credit decisions in terms of setting credit limits for your customers? And what you can see there in the red marked bars is that there are people, or there are companies which are not really making credit limit decisions here, because market and sales is doing it, or they're doing not doing it at all. This kind of stuff, mainly in smaller companies where they are not able to pay a credit manager, right? So that means they just take it purely, like if I said, they make it 100% out of their gut feeling, which is good that you should move this in. This is one of your data sources. But what you should not do only gut feeling. Take data, take information that you make out of the data, and make yourself a clear picture beforehand, and combine it, of course, with your impressions, gut feeling, or whatever you name it, and then make the credit decisions. What I can see here as well, the one of the blue big bar is the ideal solution. Almost, because almost 45% of the people who answered that in the companies that are who took the survey here say they have real credit management installed, which is mainly big companies. What we saw as well is we asked the question: do you apply the generally accepted credit management principles that the association has published, right? And what you can see is that we have a good rate at the moment already, that overall 48% said yes. By the way, we have even asked the question, this is not on that slide here, how if they do credit management at all. About 40% of the companies in Switzerland don't do credit management at all, which is, in our view, not good to not having a risk management in place, right? So what we saw as well, that the generally accepted credit management principles are internationally accepted. We can see this here, that this is in the US heavily, and also in other countries in the European Union, where more and more companies are using this framework to implement credit management properly and measure themselves against those standards. Next question was, do you use a credit scoring model? Look at this, the red bar. Interesting, right? We have 20% who said, no, not at all, right? And in our technology that we can use today, I think everyone is able and capable to use credit scoring models for their decision making. As Michal said, you can have like static or dynamic models, whatever you want, right? But not doing it at all. So this is something, there's a lot of education we still need to bring to the market. That's what we do as well from the Credit Management Association here in Switzerland. We are very close to the small and medium-sized companies. We are publishing articles on that one to give them a helping hand and to progress with all that stuff, right? Then you can see the blue bars. This is when it comes down to using credit insurance and credit rating agencies. The green bar goes a little bit into that area. Are you using new technology which is available in the web already, right? So in terms of robotics, process automation, in terms of artificial intelligence, things come up, new companies arise globally, decentralized, and give their automated way of helping doing risk management to the market on websites. Some are for free, some charge a little bit amount of money. So what you can see on the yellow bar then is classic style, like I learned when I was in the chemical industry, that there were in-house credit scoring models produced, either Excel-based or real programs that are also programmed into their ERP system and all that stuff. For this, we have roughly 17% who do that. So different questions, as I said, I will go a little bit jumping left and right. So what I want to bring here is a Swiss view, right? So what we do, of course, we are watching the macroeconomic guidelines that are published through the ETH in Zurich, which is the university there, right? And what we can see, and that goes back to my first slide when we said, okay, bankruptcies, liquidity, and all that stuff, right? What we can see here that the Swiss market index, the DAX, the Dow Jones, let's don't talk about Bitcoin in that sense. What those three are visible here is that those indices go up and are decoupled at the moment from the real economy. We know that, right? And the question or the answer to the question is, why is that? Is that finally a lot of this liquidity that is pushed into the market at the moment by governments partially end up that people or subjects start to put cash into different saving methods, like buying shares and all that stuff, to do portfolio risk management to mitigate their risk at the market. So this is not only valid for companies, that goes into private people and all that stuff. And you see there is there is a trend to see which we don't think will stop at the moment. So it will go on this high level, and it doesn't look like that this is a bubble. What the economists in Switzerland look as well as, of course, how is the GDP growing in the world. And Switzerland always is impacted directly one-to-one. So they have their indicators over here, which is the coincident barometer, and the leading barometer, which is published there from Professor Storm, is visible that we have a trend change. The barometers go up, like we could, like we have seen it in 2009, and then and the economists, they expect now that the growth rate turn towards the second half of 2021 into positive effects again, with the hope, of course, that this stays then on a sustainable, stable level again. Okay. I think that was a topic that we had in Switzerland for a while. Everyday news. What about the Swiss-EU framework agreement? You can see on the graph and the pie charts the dependencies between Switzerland and the European Union in exports, in imports, are quite big, right? So, and that's why it is surprisingly, and there are different opinions, different parties, meanwhile, in Switzerland, who debate if this was a good decision to stop the negotiations for the framework agreement. The reasons why they stopped that, you can see on the right-hand side here, which I laid out, is concerns about the about compromising the direct democracy. That's what you need to know, right? So if you, in Switzerland, if you make an agreement or a decision on that scale, the people have to vote for that directly afterwards. So a policymaker cannot at all make a decision that finally will be killed by people afterwards. That was one reason. Then one, of course, the Switzerland has a very strong above average economic position, right? So they feel that they lose from there, right? And they feel as well wage dumping, right? So what they want to see finally is to smoothen that out, and also don't bring those aggressive points into the framework as such, which the EU was not agreeing towards it, right? So what they want to achieve and still keep is this competitive tax system finally as a country, and in the long run to be like for companies as it was so far, to be really reliable and plannable over time. Let's skip the other stuff away, and so let's go away from macroeconomics. What I'm missing all the time is when I talk to credit managers, is to look at the global picture in their own companies, right? So what we always did in the chemical industry is not to look only at our accounts receivable position to manage that from a portfolio risk perspective. We also looked at inventories, which is then DSI numbers, days sales inventories, right? So DSO would mean in the accounts receivable arena, days sales outstanding, right? And you always have to look at on your supplier end as well. So they will send you invoices and you have an accounts payable position. And there you have days purchasing outstanding. Those three measures together are the cash conversion cycle, which needs to be managed and minimized, finally, on your balance sheet. And this is very important to track this, to build up KPIs and really come to a point that you find the balance for yourself and a good negotiation point, because that keeps yourself awareness of where you are today. Now, back to Swiss FinTech solutions. We have a lot of things going on, whereas I have to say that the United Kingdom, the UK, is much more active, same like Singapore or Hong Kong, right? And Switzerland is, from a fintech solutions perspective, still pretty low. We have to say as well, the competitive tax system that I just mentioned beforehand has one disadvantage. They don't pay so much subsidies, right? They said, well, try yourself your best, and they don't really support companies, startup companies on that end. So which is one of the reasons why you don't see as much as activity as you would see, for instance, in the UK. Whereas I want to mention, let's see, at least three. You have marked. You see, I have marked this in a little bit bigger. So one of the things is a crowd lending company, which is called CashShare. They are almost, I think, almost 10 years old now, and reaching a mature stage and bringing together people who want to invest money into other companies or private people who want to lend money. So very interesting tool, automated completely. They have a very efficient credit risk process running in the background. Interesting thing. So I talked to the CEO several times, and a very good thing, very good shoes. They are also growing now into the German market, which is then the access to the European arena, which is extremely interesting. Another one is System Credit. System Credit itself is an old bank of one of the bigger banks or from one of the big two, you have to say, from Switzerland, who found a niche how to provide small and medium-sized companies more, or give more access to loans, because this in Switzerland is really a gap. So usually small, medium-sized companies are not easily getting loans from banks as such, right? Which has a good point as well. So because they find then other stable solutions, but this System Credit found a very standardized fintech way and automated way how to get potential clients hooked up with larger banks. Last but not least, right? So is an interesting company that is providing credit risk solutions in terms of like a robo advisor. You would call this like a credit risk scoring model. Finally, in the web, similar that like I mentioned beforehand, the company is called Emerald Rating. It is one of our sponsors of the Swiss of the Association of Credit Management, and here the process is slightly different. It's the fintech base, so it's not focusing on data. The focus, the data, the clients that are using or want to analyze things have the touch point with their clients. They have the data. They can ask the client, give it to me. I will even sign a secrecy agreement. give me your most relevant data. It might not be 2020, it might be Q1 data from this year. Give me something even unaudited. So, and then you can go into the scoring risk calculators of this Emerald Rating company and can enter the data, even using a macro to script it in whatever you want to like. They have to answer some questions about the environment, industry, country of this company that you're using. You don't even need to put the name in place. The robo-advisor will come back to you instantly and tell you what are the key performance indicators, the measures that you have in terms of liquidity, leverage, and profitability, and what will be the maximum credit limit you can grant to this company, and what is the risk associated to it, right? So that means you get the knowledge, a tool on hand, and you take the most relevant data yourself and use it. I think this was a pretty interesting way that one is approaching. That was my last slide, so I hand it over back to Case. Thank you.